Good afternoon, everybody. My name's Andrew Hinchliff. I'm the Group Executive for the Institutional Bank and Markets business here at the Commonwealth Bank. Welcome to our panel. As you would have heard through the course of the day, you've heard from some of the top CEOs and leaders around Australia around what they're doing to tackle climate change and to ultimately meet our net zero obligations. This panel we're going to focus on those who are providing the capital to fund the transition. And to my left, I've got co-founder, co-CEO of Wollemi Capital, Paul Hunyor, that is very focused on scaling proven technologies. CBA is very proud to be an investor in Wollemi Capital and have a strategic relationship. Welcome, Paul.
Thanks, Andrew.
We've got to the left of Paul, Jason Horn, who's the Managing Director for Investment Management at BlackRock here in Australia. Welcome, Jason. Obviously one of the largest investors around the world. To Jason's left, we've got Mark Hector, the Head of Infrastructure at Aware Super, one of Australia's largest superannuation funds. And then to my very left, Marigold, the Executive Manager for IFM Infrastructure, focused very much on their renewable and clean assets. So you would have seen some big numbers flying around through the course of the day or days, anything from sort of $1.5 trillion by 2030 to $7 trillion by 2050. They're big numbers, and obviously we've got to spread that capital right across everything from agriculture to industry, the grid and energy, as well as our buildings and cities. And let's start, maybe a question, I'll go left to right, around what have we done so far, a little bit of a stock take, if you will. And so maybe Paul, talk a little bit about your business, how you're focused on allocating capital and what you've managed to accomplish so far.
Yeah, thanks, Andrew. So I think when we think about the transition to net zero, we can take a lot of positive energy and optimism from what's already happened in energy transition, and particularly the journey of de-risking that wind and solar have been on to be predictable, scalable, bankable infrastructure asset classes of the present. The reality is there is so much more to be done when we think about transitioning every sector of our economy, and we think about the next wave of emerging technologies that need to go on a similar journey of de-risking that wind and solar have been on. And these are not sort of fanciful areas, these are not out there technologies. The demand is clear. The ability to map out what needs to happen over 10 to 20 years is also fairly clear. So we can all coalesce around what needs to happen in our food systems and transition away from highly polluting fertilizers to more green fertilizers. We can all coalesce around the transition that needs to occur in waste of all sorts of varieties being converted into value, be they plastics in our clothing and packaging, be they critical minerals in our EVs and batteries, be they food waste, etc. We can all coalesce around the importance of investing into nature as scalable infrastructure-like asset classes to create more climate resilience. And we can coalesce around the iterative improvements that can be made even in hard-to-abate industrial sectors where a variety of proven technologies can be deployed into industrial sites to iteratively help with those glide paths to decarbonise. The challenge is there's a huge gap in both expertise and funding to take proven but emerging technologies from being venture-backed to actually being bankable in a predictable, scalable way and ready for the large infrastructure funds to back them at scale in the same way that we now back wind and solar at scale. And that's why Wollemi was founded. We are headquartered out of Sydney, Australia, but we're a global team with presence on the east and west coast of North America, a 30-strong team today. And what we've done is we've brought together two teams, people with decades of experience in infrastructure and project finance investing in the climate space, with people who have actually operated technology scale-up businesses, be they in the ag space or the energy transition space. Because we feel that if you bring together that expertise as well as flexible capital, you can really help these transitions scale through that that these emerging technologies scale through that funding gap, which will be very important. Finally, when we think about Australia, we think Australia can punch above its weight. There's a lot to do, but particularly in the agricultural space, but even some of the most exciting technologies we're seeing in terms of waste to value capture, etc., are coming out of Australia and have the potential to be infrastructure-like asset classes of the future.
Thank you, Paul. Jason, welcome.
Thank you.
BlackRock, the world's largest asset manager. Where do you see the opportunities, be it domestically or internationally?
Yeah, thanks, Andrew. So a lot of you are probably sitting here saying, why is BlackRock on the stage? But we are a public market shop, but we also are quite a large private market shop. So we run around about $330 billion in the private side, and about $50 billion of that is in direct or private infrastructure. Actually, in the climate and the climate transition point, I think, Paul, you said it very well. There's a lot of opportunity. I mean, we've seen the large numbers, but funnily enough, we've actually been in this space for quite a long time. I think we launched our first climate or transition focus program in 2012 when it definitely wasn't sexy. I mean, you're still looking at toll roads and airports, but we've been looking at it for a long time. If you think about the transition, obviously there's different elements across the regions. In particular, in Asia, we feel that there's going to be a significant flow of capital. So if you think about how we're investing currently with our programs, about 40% of anything that we raise in terms of our climate and transition programs are actually coming to Asia, and a good portion of that 40% is actually in Australia. So where we are focused primarily, I mean, we're focused on the grid instability in Australia. Obviously, the grid scale batteries, the BESS systems are something that we've focused on as an investment firm. We have a fairly large platform, Acacia Energy, which we brought and obviously have expanded over the last couple of years. And it's developing large grid scale batteries, traditionally near or near about some of the old coal-fired power stations. Mamora, for example, the Waratah Super Battery, they're big grid-scale batteries. They're obviously a combination of, yes, there's some trading elements, but there's also the backup power for government programs. So definitely, if I look at Australia, batteries are very important. In addition to that, we're obviously very focused on the EV charging side. Now, EV charging is an interesting one because we're not sure yet which program or technology is going to win here. So in Australia, we're focused on EV charging with marketing. It just improves the payback periods, and you're less reliant on having chargers, busy at all elements or all times. We typically deploy those in the urban spaces, but we've also placed not bets, but we've placed interesting programs in the US. So in the US, we're more focused on using rideshare and EV charging programs, whereby the ride shares, whether that be with some of the EV chargers for Uber or whether those be some other ones, whereby we know that those chargers are going to be used because the ride sharing programs are out there at all times. And then finally, you've obviously got the large superhighways in the US, whereby you need fast charging for trucks, cars, etc., that are going long distances. So it's going to be an interesting one. We're not sure where and which is going to win, but obviously we need to de-risk our programs. And I think the final point that I would say, or the semi-final point for Australia, if you look at the solar part, it's very, very well integrated. Australia is one of the highest integrated solar markets globally, but actually pairing that with the likes of batteries and using that to create not only battery programs for houses, but combining those batteries into networks and actually feeding back into the grid. We're very focused on that. Just some huge opportunities. South Korea comes to mind. 500 gigawatts of power required there. That's half as much as we've actually got in the world today. So actually there's going to be huge opportunities going forward across Asia, but obviously Australia is definitely a leading market for us.
Excellent, thank you, Jason. Mark, Aware Super, one of Australia's largest superannuation funds, where are you investing your capital as it relates to the transition to net zero?
Thanks, Andrew. Good afternoon, everyone. So I run our global infrastructure portfolio. We have about 14 people in our team. We're all generalists. We look at energy transition as well as broader infrastructure investments. We've done quite a bit over the last several years within the energy transition space, both directly into the energy sector and indirectly in some other sectors that are on a decarbonisation journey. We've made about $2.5 billion worth of investments, either invested or committed capital into the energy transition space. That represents probably about 15% of our overall portfolio to date. We'd expect that percentage to probably increase a bit over the time in the context of all the opportunities that are coming up. For context, there's about 60% of that that's in our backyard, around 30% in the United States, the rest in emerging markets, a little bit in Europe. As you'd expect for an infra investor, we probably have more than half that's in traditional utility scale wind, a little bit in solar, and we've actually got about a third in ancillary or emerging spaces where we think there's some more diversification benefits. Almost all of that money is invested in platforms with multiple underlying assets. That's intentional. We have a view that it's really important in energy more than any other space within infra to have a well-diversified portfolio, just representative of the vast array of medium to longer term risks and uncertainties that exist in the space. And there's a broad spectrum of potential opportunities there as well, so we like to kind of spread our eggs around. Beyond investments directly in the energy space, I did mention we focus on ancillary and emerging opportunities to try and find some better value for our members as well. So in the United States, we're invested in a platform that does not just sustainable power, but also sustainable mobility, electric buses, electric charging, sustainable water and waste to electricity, biogas, etc. Right here in our backyard, we own a platform called Intermodal Terminal Company that's currently building a $400 million intermodal rail terminal in Somerton in Melbourne. That would be a key enabler to move a whole bunch of freight from road to rail, which is really important as part of the decarbonisation of the transport and the logistics sector. Or even investing in fully electric powered cranes and stackers to actually make sure that we focus on decarbonisation during the actual operational phases as well. And then more broadly, across our entire infrastructure portfolio and across every single sector within our fund, we actually now have probably somewhat uniquely some decarbonisation objectives on a pathway to 2030 and beyond that reach their way down into people's individuals' OKRs and KPIs. So we're quite focused on getting Scope 1 and Scope 2 down. And I would say that we're interested in getting Scope 1 down in a substantive, meaningful fashion. I know there's a lot of talk in the industry about using carbon credits. They're kind of a last resort for us. We need to find ways to substantively reduce carbon.
Excellent. Thank you, Mark. And Marigold, IFM's $108 billion infrastructure asset manager. How are you seeing the opportunity and how are you transitioning your portfolio, your global portfolio, I might add?
Yeah, thanks, Andrew. Good afternoon, everyone. For a bit of background, IFM Investors is a global fund manager. We're one of the world's largest infrastructure investment managers with over $100 billion in infrastructure investments globally, covering 40 portfolio companies across over 20 countries. We have a long-term investment horizon, and I wanted to point that out in terms of the multi-decade investment horizon that we do invest in infrastructure with, because the transition is also going to be a multi-decade journey to get to net zero by 2050. And so that underpins our approach and thinking when it comes to the energy transition. And there's two parts and I guess the two ways in which we're approaching the transition. One is obviously, as you mentioned, the significant and unprecedented investment opportunities that the transition brings. And the second part of it is with our existing portfolio of significant critical and essential infrastructure assets, we're working very hard to transition and decarbonise those assets. Like Mark, we also have targets and goals around net zero for our portfolio. So we're targeting net zero by 2050. And with our portfolio companies, we've worked with them to develop targets and realistic transition plans, which has helped us to build up an interim emissions reduction target for 2030. So around 85% of our portfolio companies have carbon emissions reduction targets or transition plans in place, and that represents 99% of the total portfolio by net asset value and 97% of the greenhouse gas emissions of the portfolio. So we've worked very closely with our underlying portfolio companies on developing those transition plans, and also in terms of thinking about what are the sorts of strategies and initiatives that we can employ and put in place to practically take those steps to decarbonise. So there's probably two examples I'll pick on today in terms of how we're doing that. The first one of which is a strategy that we've been very successfully deploying, particularly across our airports in our portfolio, which is to support the build-out and development of behind-the-meter solar farms for these assets. That allows them to self-generate renewable power and reduce reliance on grid electricity. And with airports in particular, they've got significant land banks as well as rooftop space, which has allowed them to execute that strategy very successfully. So as an example, Vienna Airport within our portfolio, it's turned on its 24 megawatt solar farm in 2022, and that provides about 1/3 of the airport's electricity needs. Closer to home in Melbourne, for example, at Melbourne Airport, we built a 12 megawatt solar farm. Again, to put that into perspective, it's the size of about 26 soccer fields. And that is going to be followed on by plans for another 7.5 megawatt solar farm. So that's one strategy. The second strategy to help our companies transition has been to develop and implement a large-scale power purchase agreement program. So that involved grouping together our assets and use that and leverage that scale and that buying power to negotiate green power purchase agreements. And that's been very successful. We've had over 15 participants in that program now across our various phases. And it's enabled many of our underlying portfolio companies, the likes of Melbourne Airport, for example. The combination of the two strategies has meant they're able to target net zero by 2025. And really accelerate that transition of their Scope 1 and 2 emissions reduction. So we've been those examples are primarily focused on Scope 1 and 2 and what we've been doing there, but we've also been taking practical steps around and thinking about measuring Scope 3 emissions. So from that perspective, and being big airport investors, a strong focus for us has been on the sustainable aviation fuels as a solution for decarbonising the aviation industry. So we think that will be really important, and we've partnered with GrainCorp to look at the feasibility of domestic sustainable aviation fuel production in Australia. So that's one area we're looking at Scope 3 and how we can support solutions there. And similarly, other examples within our portfolio, for example, in the toll road sector, putting EV chargers at Indiana Toll Road along the highway there to support more electrical vehicles. We've also doing some trialling on one of our toll roads in Italy, at Wollemi it's called, on wireless charging technology that allows cars to recharge, or electrical vehicles, sorry, to recharge whilst they're actually driving along the road. So that's a really exciting innovation that we're seeing, but that will help reduce Scope 3 emissions as well. That's just a few examples on what we're doing around decarbonising our existing portfolio from a Scope 1, 2 and 3 perspective.
Oh, very good. Thanks, Marigold. I mean, and I think you'll all agree there's an exceptionally broad array of opportunities that are all focused on. I want to turn quickly to maybe risk and return. You all represent very different pools of capital with different risk appetite. Importantly, you play a fiduciary responsibility to maximise the return per unit of risk for your stakeholders. And then importantly, many of your stakeholders will also have an expectation that you do the right thing for the right reasons, as in you do good. And there's a question: are the two things incompatible? Are they compatible? How do we think about that? Paul, I might start with you. You specialise in first-of-a-kind type facilities, and in your words, scaling proven technologies to become bankable or getting ready for the likes of some of the big infrastructure investors. How do you manage the various risk profile of technology risk and the commercial risks to deliver outcomes for your investors, of which we're one?
I think this is...
No pressure.
Yeah, I think this is at the heart of why scaling up emerging solutions in the climate space is a little bit more challenging than in other spaces. In pure play venture capital, I know this is a way oversimplification, but generally speaking, there's a bit of a mentality of, move fast and break things and make mistakes. This space is full of CapEx intensity and project level de-risking. If we take Marigold, a space that you referenced, sustainable aviation fuel, it's simply not acceptable to sort of build things that are going to put lives at risk or are not going to function. So the typical venture style models run into a problem when it comes to building a demonstrable first working commercial plant and scaling it 2 or 3 or 4 times to then a 10th time to make it a scalable infrastructure ready asset class. And we're short of 2 things to make that happen well. One is project development expertise. There's just a shortage of this. And typically what we find is there may be a team that has a particular technology, let's say, that's quite an alcohol to fuel technology or an emerging electricity to fuel technology that could be superior to HEFA, but these teams do not really understand permitting, construction risk, manufacturing risk, and all of those elements of project level de-risking. So a big part of our job in this sort of growth gap is both ensuring that we are not taking technology risk, ensuring that there is proven demonstrable efficacy of their technology. We're not taking demand risk, and we understand that people will line up on the offtake side, but that we can lean into supporting the team build out and the capability build out that's required around project level de-risking. So in the US, they now use this term first of its kind plants. There's much written about the crisis in funding first of its kind plants. The reality is you get to 10th of its kind plant and there's a wall of capital ready to fund it. First, second and third kinds are difficult. And so our job is to both explain the return profiles that are required to fund that and have rational conversations around that, as well as provide some expertise around that. I wouldn't pretend it's easy, and I think part of what needs to happen here is, what I so enjoy about these kinds of panels is, I do think this space requires an intermingling of skill sets across asset classes. I think it's amazing that you've got, for example, decarbonisation partners investing at the venture capital end, but then you've got sort of infrastructure expertise as well. And we were having a conversation off panel earlier about sometimes these things actually move from one to the other without ever hitting private equity in the middle. And so just generally speaking, what I'd say is it's a little bit more watch this space, but there's more investment of expertise and flexible capital required to get this right.
Very good. I might come back to some of that at the end when I just talk a little bit about the bank's approach to allocating capital as well and what we're doing. But before I do that, Mark, I'm going to come to you and maybe just focus in on the question at the end of my commentary there, which was how do you reconcile some of the ESG objectives with the return requirements of your investors?
Yeah, interesting question. Get a lot of those from friends and family. Colleagues in the industry as well. Look, we do consider ourselves to be a force for good, and we're lucky enough that's very much a function of our size and scale that we're generally making investments that impact on a large number of people, as well as it being a function of our intent to kind of do the right thing. But I would say first and foremost for Aware Super and every other super fund in the country, we're required by law to make sure that every single investment that we make, without exception, delivers best financial returns to members, the sole purpose test. So we cannot make any investment because it feels good or is socially acceptable or ticks a nice friendly ESG box. Having said that, obviously where we do find investments that we think financially stack up, we do need to make sure they still pass a detailed ESG DD gate. So that can mean upfront, when we go through screening assets, sometimes assets do get screened out on an ESG basis. I mean, some obvious examples there are the whole market has considered some obvious asset stranding risks with respect to certain fossil fuels like coal, so we struggle to invest there. A lot of people immediately jump to the E component of ESG, which is understandable. We really do have a very broad focus on the other letters and the other factors, so that also includes upfront screening. I could give you other examples, but in the interest of time, we do a lot of work if we invest in an existing asset with an existing set of founders or management teams to do detailed due diligence on the individuals, their track records, do they act conscionably? Do they act ethically? And every now and then we do screen out investments because they've got some red flags that we feel that are just insurmountable in terms of challenges to long-term valuation. But by and large, when we're doing our ESG DD, it's not so much about screening stuff out, but it's along with all the other financial DD that we do, we're looking at a whole range of non-financial factors that we believe are really important to long-term value, that if we're not focused on those, managing those over time, we think there's a good likelihood that you'll see negative impacts on long-term cash flows, long-term valuations, or liquidity. So in that sense, we don't really typically see ESG as something that isn't reconciling with financial returns. In fact, we think that it's all about protecting and enhancing value. Some examples that I think people are aware of, a long list, but these are some factors that are pretty important to us. We've all heard about diversity, inclusion, positive cultures, minimum acceptable standards of conduct. They mean a lot to us, and within our portfolio companies, talking to our peers, we think it's just an absolute no-brainer to have diverse perspectives and opinions around the table, people that feel safe and valued, having cultures where people don't have to worry about bullying, harassment, discrimination. We absolutely think that that's got to be linked to long-term value, where those people feel valued to actually come to work and are thriving. So that will mean that we do testing within our portfolio companies of how people are performing, and if we see people that are not meeting those standards, they'll get development training, and if they're consistently breaching those standards or materially breaching them, then we will resort to terminations, and that includes whatever the seniority of those people. Cybersecurity, that's become huge in a range of sectors. For us, we own a number of sensitive infrastructure assets. You absolutely need to spend money on systems and improvement in processes there. We've all seen firsthand that if you don't do that, there's both short-term and long-term reputational and financial consequences to you and your customers. From a safety perspective, I think that's been a strong focus on physical safety for a long period of time. Psychological safety has become more important recently. Again, we think it's a no-brainer that both for the reputation of the company, attracting and retaining good quality staff, you need to have a focus on making sure that the workplace is safe. Our company and our team, we're a big believer in good governance, robust governance. I know a lot of people think, what does that actually mean? From our perspective, some simple things like making sure you've got an appropriate mix of skills on your board, you've got full transparency and a comprehensive set of reporting of all the key activities that are actually going on with the company that are flowing up to the management team and the boards. We absolutely know firsthand that you've got to set OKRs and KPIs for management teams that are aligned with what the shareholders actually want, a broad range of financial and non-financial factors. Last but not least, carbon. Obviously, that's the one that most people jump to. We definitely believe that we're in an environment now that you just can't sit back and do nothing. There are some assets that have lower carbon footprints, but the reality is there'll be more and more investors and banks like us that'll have more specific carbon reduction targets, and it means that particularly for those that have got higher carbon footprints, if you're not doing anything as time goes by, it's going to impact in terms of what it's going to cost you to rectify that, or potentially impact future valuations or liquidity. So we need to do that. But what I would say on carbon as well, speaking frankly, is that there are clearly some sectors or assets that have much higher carbon footprints that are harder to abate. And there's no doubt that there are some trade-offs there between reducing carbon and impacts on financial returns in the short and the long term. And they're not straightforward decisions that can be made.
That's a very comprehensive answer. No, thank you. Marigold, I might come to you. You've got a global set of stakeholders. You obviously run global infrastructure. Maybe two aspects to the question. What would be the most exciting sort of innovations or breakthroughs you're seeing globally as it relates to your global portfolio? And then also how you think about those over different time horizons, sort of in the short term versus sort of the medium to long term, which certainly Mark alluded to in his answer to the question.
Yeah, I think over the long term, there's a lot of new technology, emerging technology, or some existing technology that just needs to be scaled up that will support the transition. So it is great to hear, there's capital like Wollemi capital that is supporting the scaling up of technologies and the maturing of capabilities around those sectors. Because as infrastructure investors, we typically seek to invest with proven, at scale, established commercialised technology. Having said that, there are some interesting technological innovations happening at our assets, like I mentioned, the wireless EV charging, for example. But one other example I'd give, which is actually one of our investments in the US called Green Gas. It is a renewable natural gas producer and develops projects that produce renewable natural gas using pretty established technologies. We don't see it a lot here in Australia as a sector, and despite the technology being pretty well established and mature. But what Green Gas does is that, if I sort of try and paint the picture for you, it turns basically agricultural waste streams into renewable natural gas. So it solves, firstly, waste problems, and secondly, it provides a solution that it provides cleaner gas to counterparties who purchase it. So if you can sort of picture a poultry farm and processing facility. You can imagine there's a lot of poultry waste. It typically gets flushed into a wastewater dam on site, and as that organic matter breaks down, it produces methane, which is getting emitted into the atmosphere. And as we all know, methane is much more harmful than carbon dioxide for the environment. So Green Gas's business model is to come in, use anaerobic digestion technology, which is a tried, tested, mature technology, to basically capture that methane, clean it up, and what you're left with is renewable natural gas, or biomethane, which is almost chemically equivalent to traditional fossil fuel gas. So it can be used in the same way as traditional fossil fuel gas, can be transported and stored in the same way. So companies like that require a lot of gas in the manufacturing processes, large commercial industrial customers like Mercedes-Benz, for example, or BMW, which have significant manufacturing facilities and operations in the US, they purchase this renewable natural gas, which displaces their use of fossil fuel gas. So this is a way the projects are individual, but we are able to roll it out and scale up the business by doing one project after another and repeating that business model across a range of agricultural feedstocks. So that's something really exciting that we've seen and invested in the US. We'd love to do more in other regions in that space as well.
A very interesting example. Jason, maybe a bit of a focus on risk-return trade-off globally versus Australia, APAC. If you see a difference, where do you see the opportunity? Are we going to be readily able to attract the capital necessary to drive Australia's transition?
Sure, yeah, Andrew. So I think it's an interesting question, and actually Mark and I were debating this just before the session too. I mean, I think the global view is that the return profiles, especially in the transition and infrastructure for Australia, are actually a lot tighter than what they are. So that's the first comment I'd make. I think the regulatory regimes globally are starting to change some of the return profiles. So if I had to rank, and bear in mind what I'm talking about, sort of our value add core plus strategies, which are targeting mid-teen returns. If you see the types of programs that we're investing in, the US is obviously catapulted to the top of that, and that's simply because of some of the big regime shifts like the IRA, the Inflation Reduction Act, and that's been great for investment throughout the US. Although we're also talking a little bit with Paul earlier about what happens with elections and is that sustainable? Is that going to be there a longer term? So at the moment, it's turning, I guess, slightly borderline investments into attractive investments. We've typically steered a little bit clear of that, but you can still get some pretty good relative value in the US. I think Europe, from an investment standpoint, especially in where we're playing, traditional sort of transition infrastructure programs, that's a little bit more expensive. So we're finding Europe, and they're probably a victim of their own success because they were quite early adopters. They made some very good strategic decisions, but obviously now there's a lot more, I guess there's a lot more capital chasing the very similar deals there. So we find Europe a little bit more expensive than the other two. And then finally Asia, we still think that there's great return profiles to be made in Asia. And that's simply because you're getting, if you look at, say, Korea, you're getting state-sponsored long-term PPAs. We talked about some of these before, whereby you're getting these offtake agreements that may be 20 years for whether it's offshore wind, whether it's battery profiles and redundancy. So there's still a lot of benefit there, I guess. And then finally, here in Australia, we're typically using build-to-core strategies in Australia, so we're really focusing on developing assets. So I talked about the batteries and Acacia, for example. That means that we're not using a lot of debt in these at the moment because we need to de-risk. I think Mark did a great job just talking through the fiduciary of clients. From a BlackRock standpoint, clients and return for those clients is obviously number one, but the risk return needs to be there. So we're not prepared to take risk if it's the wrong type of asset. And therefore, if you see what we're doing here, a little bit less debt, but you can still get those mid-teen returns that you want. What we've traditionally seen is as we start to put more debt into these returns, maybe you get 100 or 200 basis point more, but actually you can probably, investors will still take sort of a 15% IRR return. So I think in ranking the US for now, and then Asia, Australia, etc., and then probably Europe as a slightly more expensive market.
Okay, excellent. Thanks, Jason. Let's go a little bit on to friction and breakpoints. What are the key inhibitors to allowing capital to flow into the transition and meet the numbers that we've spoken about? And by friction, it could be policy, it can be tax and subsidies, things like carbon border adjustment mechanisms. Where do you guys see the friction? I'm going to start with Paul. Where's the core source of friction, if at all? And what would you want to see happen that it really enables capital to flow into the right areas?
Yeah, sure. I guess picking up on where Jason just left off, I think regulatory uncertainty, you can have both regulatory tailwinds in this space, but regulatory uncertainty is a really big friction at the moment. I mean, quite specifically, I could name a number of aspects of the IRA in the US that ought to be transformative. There's a Section 45V that's supposed to be transformative for the green ammonia sector. There's another section of tax crediting legislation that's supposed to be particularly attractive for waste heat to energy capture. But the reality is capital is sitting on the sidelines with uncertainty over the final drafting of these pieces of legislation, but frankly also just the prospect of what might happen in November. Will legislation be repealed or not, etc. So I think in that world you can see regulatory tailwinds falling your way, but what you can't be searching for is business models or projects that only stack or that rely on such a green premium and that they only stack if the regulatory cards fall in your favour. So what we try and do to navigate that is we also look for business model innovation, especially on the developer side. Mark referred to investing in platforms. One of the great innovations that we're seeing at the moment is emerging developers adopt more infrastructure as a service models. So for example, we've invested in a developer in the US called Cannon Energy. And in fact, exactly what they do is waste heat to energy capture projects on hard to abate industrial sites like gas-fired power stations that are an important part of energy transition, or steel or concrete plants. But they're doing this in a way that transfers it from a CapEx spend decision for the industrial owner into an OpEx decision and an annual service fee. And they'll actually integrate to the grid. They'll manage the project. It's actually quite old and proven technology, the waste heat to capture technology. But what they're also doing is they're internalising that regulatory risk of what happens with the tax credits. And it happens to be a bonus to them if they come through, but they're not relying on them coming through either. And that's a way of still accelerating and getting the transition to occur in the face of regulatory uncertainty. So I think business model innovation on the project developer side is also equally important as much as technology innovation is.
And Mark, I might go to yourself. Just any sources of friction or policy clarity that would help the superannuation industry allocate capital into this space?
There's a few. I think the state governments have actually recognised as part of the planning of the transmission and reses that just like access to capital, construction resources, supply chains, access to capital, I might just make a qualifying statement that there's probably an assumption. I mean, the numbers are mind-boggling that you've been through about how much capital needs to flow into the space. There are natural limits to how much our fund and other super funds can actually invest in the space, which is related to the growth of our funds, but also the desire to have a diversified portfolio. As much as we'd like to put more money into energy transition, we do have an obligation to our members more broadly to have a diversified pool of capital that can find good returns in other spaces as well. I wanted to mention resources and supply chains as well, because it's not something that financial investors would typically be concerned about or just take for granted. But everyone knows, unless you've been living under a rock, that we've got just an enormous challenge to actually find the people, the resources to do what we need to do, especially in the context of everyone else in the world looking to do the same thing. So from an equity investor's perspective, especially if you're looking to take some earlier stage development risks as well and not just invest when you're shovel ready, we focus a lot more with due diligence on the residual risks to us of potential time delays or projects not actually proceeding at all. And even where we know through first-hand experience, even where you think that you pass that risk on to contractors, there's never 100% risk pass-through, and those features can come back to bite you. So we are looking through to those features. Maybe just one final comment in the interest of time. There's always a lot of focus on the impacts that really big centralised generation can have on the grid. It's hard to get away from that. Some people that know far more about this space than what I do have suggested that we really need to move a lot more towards distributed generation. So we've actually invested in an early stage platform called Birdwood, where we're doing a whole bunch of small-scale distributed solar and batteries for SMEs that is a lot faster and cheaper to actually connect into the grid. So we think it's a good way of helping out the customers, but also generating some alpha returns for our members as well.
Yeah, very good. And look, one of the themes of today and one of the reasons for momentum is the enormous amount of collaboration and coordination we need in order to tackle sort of the complex problem, of which you're all playing your part in terms of alliances and collaboration and working with the likes of banks and government. Marigold, I might ask yourself. I mean, you've recently launched the IFM blueprint around tackling Australia's transition. Maybe some comments just around that and how that's playing a role in collaboration.
Yeah, you're absolutely right, Andrew. We've talked about the enormity and the size of the opportunity and the challenge, and the need for collaboration, and that will really be key to the transition. So it's within that spirit, and with the spirit of providing solutions, being solutions-oriented, IFM together with a number of large super funds put forward what we call the Energy Blueprint, which sets out a number of recommendations for government around policy that will really unlock and accelerate more capital into the transition in Australia. We've focused primarily on three aspects, which is transmission, and we've heard, I think, across many sessions today around transition being a key bottleneck to more renewables development. And we've also focused on batteries, which again we see as a great opportunity for Australia to do more in that space, and again support the build out of more renewables. And then thirdly, as I mentioned, we see a great opportunity for a domestic sustainable aviation fuels production in Australia. So we've set out a number of recommendations around policies around SAF, which we've put through in the document. I won't go through all the underlying specific recommendations, but the blueprint is available on our website for those interested. But at a high level, they're the aspects that we think we can invest into, superannuation capital can invest in today with the right policy settings.
Thanks, Marigold. We're almost out of time, so I might wrap very quickly. Hopefully you've got a flavour for the size of the opportunity and the diversity of opportunity through our guest speakers' comments. We do think it's extraordinary. I think Australia's got a huge role to play in it. There are very different pools of capital that exist across the economy, which all have a very different risk appetite and return profiles. And I think it's really important that we continue to partner together to collaborate on how do you bring those different pools of capital together to ultimately solve the most complex problems. Policy will play a really important role in it. But ultimately it's conversations like this that I think will help unlock, the power of capital that, will help accelerate the transition. So, I want to thank each of you for joining us here today. I think hopefully you found the comments extremely useful. Please join me in thanking our guests.